Seth and Marc, the floor is yours.
All right, thank you very much, Brendan, for that kind introduction. Got a little nervous when you said Chief Financial Officer. So, really looking forward to talking to everybody about what has been going on. I know these last 15 months, at least for me, it felt like 150 years. And I'm really hopeful that the next time we do this investment update, that we can do this in person. We have a lot to cover and some thoughts on what's going on and why, and we'll try and explain in some of the gory details that Marc and I like to get into. But really, we want to talk about how did we get here? Where are we exactly? Looking back at the first half of 2021, and even going back even further into 2020, how did that lead into 2021? And then we really want to talk about what do we expect for the rest of 2021 and beyond. Certainly the big conversation that we're hearing about and that's in the media is inflation. And we're going to take a little, not even so little, a deep dive into that and what's the data telling us.
Before we go on, we do have to read our important disclosure information. So please remember there can be no assurance that the content made reference to directly or indirectly in this webinar will be profitable or suitable for your individual situation or prove successful due to various factors, including changing conditions and or applicable laws. The content is only reflective of current opinions or positions and is subject to change at any time and without notice. Moreover, you should not assume that any discussion or information contained in the webinar serves as the receipt of or as a substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. A copy of Affiance Financial's current written disclosure brochure discussing our services and fees continues to remain available upon request.
So where are we? So the chart you're looking at is the S&P 500, 500 largest companies in the United States, as well as the aggregate US bond index. And we're going to take you back in the time machine back to January 2020. And the Fed had begun to ease back in 2019, dropping interest rates, and again, being more accommodative. Before that, in 2018, they had started shrinking their balance sheet and they had backed off on that. And so 2020 actually started pretty good. You could see that the market was going up, and then COVID. And literally the economy stopped and the stock market followed suit and literally fell off a cliff. The drop was extremely steep. And then we started the period of recovery, which was actually one of the fastest recoveries in stock market history. Fast forward to September, October, and we had not only had we come back, but we were in sometimes a little bit higher, a little bit lower in terms of where we were as we started leading into the 2020 election, which happened the first week of November. Week after the election was the announcement that we had vaccines, and literally away we went. So again, all of that rise in the market really includes the recovery. So it includes the drop and the recovery, and you had a 39% over the last basically 18 months in the stock market. Just an amazing an amazing return over the last 18 months.
And I think it's also important to point out it's been a long, really smooth ride. So we're up more than 5 quarters in a row, and not just up 5 quarters in a row, but up more than 5% per quarter for 5 quarters in a row. So really, really tremendous. Last time this happened was 1954, actually, and the market continued higher after that. Similar kind of monetary situation, but clearly not a pandemic. I think the other important point to note here is that bonds, while clearly not as exciting as stocks, still returned about 6% over this period. Clearly a little bit weaker in 2021 as interest rates rose, but this is one of the reasons that we continue to hold bonds in our portfolios is for this diversification effect. When the market was down 34%, bonds were off just a little bit. and so provided that stability and ballast to portfolios. So I think important to see both sides of the portfolio here, both stocks and bonds. Looking just at this year, so this is 2021 to date through just a few days ago, markets show very strong returns. US market leading the globe, still year to date up 17, a little more now, but the international market's strong, still up 10, not as much as the US, but up 10. And emerging, I guess, probably one of the surprises, a little weaker than we thought it would be. Certainly started the year off really strong. That's the green line here. And they really tapered off through the year, partly due to some weakness in China as they continued to have some problems controlling COVID. The bond market, a little weaker this year as interest rates rose. Bond prices and interest rates tend to move in opposite directions, or they do, not tend to, they do. It's a mathematical situation there, that's how they work. And so we've seen bonds be a little bit weaker this year, flat for the aggregate index, and long-term treasuries, which are the most sensitive to interest rates, down about 6%. So a little bit of a tailwind to on the stocks and a little bit of a headwind on bonds here. Overall, though, really, really strong year for global markets.
I think also, Mark, one of the reasons we hold long-term bonds is that negative relationship with stocks. When stocks tend to drop off, we have long-term bonds can act as a hedge to that stock market risk.
Yeah, that's a good point. That slide doesn't really show up, but if you went back to the prior slide and showed the long-term treasury bonds, not the ag, you would have seen those were up like 15 to 20% when the market was down 30. So yeah, different reason for holding those for sure.
So the big story is COVID. And as you can see here from this slide, those countries that are in dark green are those that are further along within vaccination. So you can see United States, Canada, Europe, parts of Asia, China. Those are certainly the countries that are much further along. And as Marc had shown, those stocks in general, with the exception of really China, which is a little bit of a different story, have really followed suit in terms of stock market performance. So really just a dramatic story. Again, COVID being the big driver of really recovering economically. Looking at a little bit more detail in the United States, you can see which countries are further on the vaccination in terms of per capita. And certainly it is in the more populated states, such as the East Coast, West Coast, and Midwest. And so while we may not have made President Biden's goal, we certainly have made a long way in terms of vaccinations, and that has led to really people are going out more, people are not wearing masks, really restart to the economy. Certainly we're aware that the Delta variant is concerning and something that we're watching closely. But right now, at least looking at the data, it's really been really dramatic. The number of deaths as well as the number of deaths has dropped dramatically. The number of new reported cases has dropped dramatically when you look back at like end of December, beginning of the January, February, beginning of 2021. And so really, again, I think it's the recovery from COVID and the vaccinations that has really told the story of where this economy has been going.
All right, here is what I alluded to earlier with the audience participation feature. So if you can see on the slide here, if you go to slido.com and enter the password Affiance, we'd like to hear from you. And you can also use the QR code if you would like to participate on your phone. But we'd love to know, kind of talking about COVID and vaccination rates, what's going on with different states, different countries. How comfortable have you been going out? I guess it has been a little bit hot for those of you in Minnesota, so you might be not going out for other reasons. But as COVID related, looks like we're having some responses coming in here. Most seem to be very comfortable, but overall getting out just a little bit. Seth, you've been doing anything with your family? Have you guys been going out at all?
We have been. We've been going out to restaurants. We went to see a movie. That being said, I'd say there's been a little bit of concern with regards to phone calls. My wife works as a nurse, and she can attest that there's been more people calling with COVID, specifically the Delta variant. So it's something that we're certainly paying attention to. So our comfort level has been dropping a little bit as case counts have been rising.
So maybe find you in that mostly comfortable category.
Exactly.
What about you, Marc?
Well, I think we're probably on the mostly comfortable side for the most part, but certainly the news is starting to influence our feelings about that a bit. And you know, we actually attended an outdoor concert last week, and it didn't seem like anybody was too concerned about COVID with 25,000 of our best friends there. But I think in general, pretty comfortable. Yeah.
Great. Well, it looks like still have a few responses trickling in, and it seems the audience tends to agree with you. Mostly comfortable or very comfortable. No one in the category of not comfortable at all, which is great. It's a beautiful time in Minnesota. Hopefully, you can get outside before winter comes, or we have to go inside again. Who knows what the future holds? But we shall see. All right. I think it doesn't look like there's too many more responses trickling in. We'll have another opportunity to participate in the conversation. So if you weren't able to get into Slido, that's perfectly okay. We'll hear from you at a later point in the presentation. But again, slido.com, the password is Affiance, or you can use the QR reader on your phone.
Yeah, I think the interesting thing is probably if we had this a week ago or 2 weeks ago, probably the majority of people would have been very comfortable. And so it shows how quickly things can move.
Absolutely.
Well.
Absolutely. News is changing. Data rates are changing. All the statistics. Who knows what's going to happen after the Olympics and what that looks like with the situation in Japan. But very, very good point.
Most people are pretty comfortable. Okay.
All right. That sounds great. Thank you again, everyone. And there'll be another opportunity coming up shortly.
Thanks, Brendan. Digging into sort of what happened here. So we certainly have highlighted the fact that COVID was the story, the vaccine, the solution to getting back on track. But in the government shutdown that happened, they essentially flipped the switch around the world, stopped the economy, the Ferris wheel stopped. And how did they keep it going? And how did they get back on track? Well, fiscal and monetary stimulus. This is a circle chart, if you will, of monetary and fiscal stimulus over the past year or so. And the number is very significant. It's hard for me to actually fathom this number. $19.5 trillion poured into global economies over the last year to get that flywheel going again, to keep that our economies intact and back on track. And I think it's just really remarkable. We've never seen anything like this in history. And just to put in perspective, you know, our economy, US economy, is about a $22 trillion annual economy. This is the equivalent of putting a whole US economy to work again on top of around the world to get things back on track. This is just a massive number. And clearly it's had a big effect.
And more money's been going out the door.
That's right. There's still child tax credits coming out. There's still another infrastructure plan on the table. It's not over.
So what's the impact of all of this spending by both the Federal Reserve, other central banks, as well as governments? And that is what we call money supply. And what you can see on this chart going back to 2016 is that money supply has increased by about 50% in a very short period of time. So money supply tends to grow, but it's a pretty smooth line. And then you see the impact of what's happened. And when we talk about money supply, this is real money in people's checking accounts and people's savings accounts and money market accounts. That's what we're talking about here.
Seth, this is kind of a picture of that transfer, if you will. The government sent money to people and people put it in the bank. And this is kind of a depiction of that transfer from the government to the private sector here.
Yeah, and you can see that here in terms of personal savings rates. So this is, again, how much have people saved? Going back into March, no one was spending money. The economy basically came to a standstill. You could see that the personal savings rate jumped to close to 35%.
You couldn't
That
spend
dropped.
money. The economy was closed, right? I mean, there was nowhere to go.
That dropped off really quickly, but then spiked back up again with the spike in COVID. Today, it's dropped off, but it's still at 12.4%. The last data we have is of May, but that's significant. That's about twice as much of savings at the savings rate as what we had back prior to COVID. So just a dramatic increase in consumer savings.
Yeah, clearly consumers are flush with cash.
Yeah. Now, in the meantime, we also see consumer spending. And so again, looking at the data, you can see a positive slope that consumer spending increases each year going back to 2016. And then you can see the COVID cliff. It just drops dramatically. But look at the spike back up, really dramatic, and where we are today. Consumer spending today is greater than it was back in 2019. So a good chunk of the saving has actually been put to use and is going into spending. And we're hearing that anecdotally.
I think it's amazing to see that not only have we met, but significantly surpassed the pre-pandemic spending levels. That's just astounding. So one of the things to realize is that spending is really not even, though. And one of the places that we've seen spending really take off is in the restaurant and travel industries. Those are industries that were particularly hard hit by the pandemic. And this is just some data that shows the cliff, you know, when restaurants and travel literally stopped in 2020, rebounded a bit in the spring, sort of flat through the summer, fall, and winter, and then just took off again this year. And it's kind of, I think, pretty neat that we see something like open table reservations. We get that data that didn't even exist, you know, 10 years ago or so. And so some of this real-time data that shows us how quickly things are reopening.
And this is not only in the United States, it's a global phenomenon. So what we see is dramatic economic growth across the board. Again, going back, so let's just think back. Prior to 2007, our GDP growth rate was in the 3s. After 2007, the financial crisis, for the last 10 years, our growth rate was positive, but it was a step lower at about 2% per year. 2020 happens, we see negative GDP, no surprise there. And then 2021, our expectations are 6.4% GDP growth in the United States. And in 2022, continued growth of 3.5%. So just these really dramatic swings in terms of economic growth.
I think one of the questions still is, you know, that 3.5 number for 2022, you know, I think that's maybe even a little bit conservative today. And even 2021, the stimulus, you know, really has a significant effect. And one of the questions we still have is how long that effect lasts. You know, how long does that extra money burn out there and continue to fuel that excess growth? If we dive a little deeper into some of the data underneath, looking at the services and manufacturing purchasing managers indexes. So this is a representation of what's going on in both the services and manufacturing sectors. And after the pandemic, you know, crash and then just rebounded so dramatically to highs that haven't been seen in decades. And, you know, hitting over 65 is just incredible how quickly manufacturing and services rebounded, you know, both in turn. So really didn't get a huge disparity there. Now, recently, we have seen them roll over a little bit, and we know there are some supply constraints and labor market tightness that's starting to show up in the news and in numbers, and, you know, certainly represented by some of the rollover here, but still very strong numbers. And just to get a representation of where this is, the 50% line here, or 50 line in the middle, is the divider between expansion and contraction. And so, you know, we're just way up in the high levels of expansion still at this point.
All right, it is that time again. We are going to be using Slido and we want to hear from you. Again, slido.com, password is Affiance, but you can also use your QR code. But we want to hear, did you save, spend, donate your stimulus check, have some extra savings? How did the pandemic affect you? And while you're answering as well, just a reminder, you can submit questions to the Q&A for the end of the presentation. We've had a few come in already, and we'll do our best to get to all of them. But feel free to submit those questions, and if they're not answered during the content, we'll do our best to get through them at the end. So it looks like kind of all over the board. Spent it, didn't get a check, donations. Everyone's obviously in a little bit of a different situation. Marc, where did you find yourself on the spectrum?
We did not get a stimulus check, although some of our kids did.
So having to make sure that it was used judiciously or prudently, perhaps.
We were very careful to help them figure out how to spend and save those dollars. Yes.
Perfect. Seeing a lot of donations, which is phenomenal to hear. Obviously, here at Affiance, we do enjoy giving back, mostly through our events, but also monetarily as well. And glad to see our clients follow suit as well. And Seth, I know you had a little bit of a change during the pandemic and an addition to your household. I'm sure that perhaps increased spending just a little bit.
Yeah, we were one of the many who got a COVID puppy, a Cavapoo, and yes, I would say a fair amount of money has been going to toys, food, and vet bills. Yes, he's spoiled rotten, to say the least.
What about furniture?
No, they just get chewed on.
So maybe a furniture budget in the future, but you're not alone. I know that we've heard from a lot of clients, either home or perhaps a pet. And for those of you that do work with Seth or work with Seth and myself, you probably have heard the assistant in the background, perhaps during some of the meetings as we work from home and work on the office reopening plan. But otherwise, a very, very cute addition to the family. So loud, but definitely cute. So looks like responses are starting to stop trickling in, but again, kind of all over the board, seeing save, spending, donations, which is really good to hear.
I think it's interesting to see, many of the savings comments here, and that certainly shows up in the data, right? I mean, we kind of showed that before, but this is sort of a little anecdotal evidence of, yeah, this money got saved. That those bank deposits increased and they're at record levels.
And on the spending side too.
Right. Both places. You're right. Both places.
Yeah. It depends on the year. For the Minnesotans, I feel like winter was a little bit easier to save than spend.
So, I mean, I think we've been telling a lot of good news in terms of where we've been from COVID, what the federal government has done, and how that has impacted the economy in a positive way, manufacturing, GDP growth, etc. So what's the problem? Well, one problem is inflation. Inflation being rising prices. And one of the questions that we have is this inflation going to be transitory, or is it going to be permanent? Is it going to be with us for a long time? And some of the factors that influence inflation are money supply. And you saw what happened to money supply, increased by 50%, and material costs. And so we're going to take a deep dive into inflation and talk about what we see is going on.
So just as a little refresher, what is inflation? So just an example, if you could buy 3 hamburgers for $4.99 before, and now you can only buy 1 hamburger for $4.99, what happened? Well, your money doesn't go as far, right? Reduced spending power, essentially, is what they call it. And that is an example of inflation. So while it's a little simplistic, you get the idea. So why do we care? Why do we care about inflation, the general rise in prices? Well, a few reasons. So first, it does reduce your purchasing power over time, what we just showed. Second is it can create price instability, which impacts commerce. It's much easier for commerce to take place when people have a pretty good idea of what prices are going to be. That helps things flow smoothly. When they don't know, it definitely reduces the stability of commerce. Lower bond prices from rising interest rates. So if we're afraid that inflation is going to get hot and run away here, interest rates rise like they did early this year, and bond prices go lower. So that is one of the other impacts. Higher borrowing costs. So businesses and consumers end up paying higher rates to borrow money. That affects many markets, from industry and manufacturing to the housing market and more. So we know that higher inflation brings higher borrowing costs. That generally also slows down economic growth. Finally, the risk that wages may grow more slowly than prices. And so kind of leads back to that purchasing power issue, but this is something that you don't have as much control over, and that worries people that, hey, my groceries yesterday cost less than they do today, but I didn't get a raise. So that's tough. That hurts, right? There are some benefits, though. There are some benefits to inflation. Having some inflation accelerates current purchases. I mean, relative to deflation, right? Where if you had a deflationary environment, spending stops. Why would you buy something today when it's going to cost less tomorrow, right? So that really hurts economic growth. So having a small, moderate level of inflation is positive from that perspective. Debts can become less expensive as those inflated dollars are less valuable in the future. So that's a positive. And stocks in general and real assets tend to be more attractive than bonds in an inflationary environment. So that's all good and well, but really, why do we care about inflation? Those are real reasons, but we really want to find out, when's the Fed going to change their policy, right? When are they going to start to raise interest rates again? Because that really has a big impact on the economy and all of these other issues collectively.
I think, the other thing with inflation is it like a one-time thing? Is it more of a grinding inflation? So different types of inflation can certainly have different impact, whether companies can adjust to those higher prices. So the group or the entity that's responsible for managing inflation is the Federal Reserve. And they have two things that they need to do at the same time. One is, on the right side of this balance of the scale, is manage inflation in terms of how much inflation do they want. And they've traditionally pegged about 2% is really their goal of inflation. The second thing that they need to do is they need to manage full employment. And so they use the tools at their power to try and manage the level of unemployment. And today, the Federal Reserve has said that they would like to see unemployment go down and get to a level of what they would call full employment.
Do we know kind of what that level is, Seth?
I believe it's going to be about 4% or so. They have not been really specific on that number, but it seems to be in line with where we were. We were less than 4% prior to COVID. Okay. That seems like that's the right number today. And the Federal Reserve has certain tools at their disposal, and that is that they can control interest rates on the short end, and they also have the ability to buy bonds. The bonds that they traditionally buy is government bonds, as well as mortgage-backed securities. And they're currently buying about 120 billion bonds a month. So those are the two tools that they are currently using to manage interest rates and inflation, and in their effort to grow employment.
So we talked about employment. That's an important piece here. And this is a graph of people, the unemployment rate, going back to 2001, 2002. And you can see through the past two cycles, the unemployment rates vary. In the 2000 cycle, we saw unemployment rates get down below 5%, at like 4.5% range. And then in the last cycle, last January, the unemployment rate got down to about 3.5%, so really low. Of course, COVID hit, spiked, economy closed, nobody could work. We haven't seen a 15% print in history, really. And then the recovery, the dramatic recovery and unemployment coming down dramatically to, about 5.9% today was the June print. I think, clearly significant progress made in unemployment, not quite, again, to where the Fed wants to be, like Seth said, probably closer to 4%. But I think one of the interesting things is the job market's clearly changing, and a record 4 million people quit their jobs in April, quit their jobs. So yes, we're getting a lower unemployment rate. At the same time, some people are leaving jobs. And part of that is, I think, due to COVID, and we were remote for a long time. People got a chance to kind of think about what they wanted to do. Can they still work remotely? And the job market clearly is changing. And it's been tough to get people to work, right?
Yeah, I think that the Federal Reserve is probably going to want to make sure that that 4% is going to be lasting before they start using tools to make major adjustments. Although they're going to be giving some speeches in the next 30 days or so that may give an indication of what they're going to do.
Right, they'll be at Jackson Hole, right?
Exactly.
So unemployment clearly going the right direction, but still some labor market friction. And so what's happened? Well, to attract workers, they've had to raise wages. And so this is wages going back to, again, the same time period, about 2001. And yes, they've bounced around a little bit, but during COVID, we saw wages drop off, clearly nobody working. But since that time, spiked dramatically, and we are now seeing labor shortages. We're seeing large employers, in fact, the country's largest employer, McDonald's, offering major incentives to get people back to work. And I think it's, partly a timing issue here, where the federal unemployment insurance ends in early September, that extra $300 a week that many unemployed people have been getting. And I think, we'll see real changes happen after September. When that ends, I think that'll lead to a more normalization of the labor market, and we'll see some of these effects moderate.
And keep in mind that that percent changes from a year ago, so you're going to see dramatic swings. The big question is going to be, is this a little bit more permanent, or really what's happening here? It's going to take some time for the data to kind of sort itself out.
So you might ask the question, is there inflation? Well, yes, there is inflation. I don't think there's a question about that. So this is the consumer price index. We've certainly shown this data many times. But the two lines are the core inflation, and that strips away the more volatile food and energy prices from the total consumer price index. So blue, consumer price index, a little more volatile, including food and energy, and the red being the core CPI. And you can see the core CPI has really trended right around that 2% line for quite a long time. COVID hits, it drops off as economies shut down, and then really spikes here into 2021 significantly, over 4% for core CPI and a little over 5% for the overall index. So clearly, prices went up fairly significantly.
And we're seeing that inflation at the gas pump as well, where you can see that gas prices significantly increase. Keep in mind that the results of inflation are not only what happens with the Federal Reserve, but it also is supply chain issues, it's employee issues, finding the employees to do the refining work, it's government decisions on how things are getting funded. So there's a lot of pieces in here that go into the numbers. And certainly the whole COVID supply chain disruption is a part of that story in terms of rising prices.
And I think to that point too, I mean, one of the questions we asked was, hey, is this something that's permanent? Are these prices going to stay high forever? Or is it more transitory in nature? And I think that's one of the things that, we're going to try to answer here a bit. Higher gas and oil prices are clearly a result of economies reopening around the world after the shutdown and inventories being drawn down in the oil and gas markets. But oil and gas markets, have many other input factors, including the US dollar, which has weakened over a period of time and been part of the story here, as well as OPEC and the US oil manufacturing business. So I think there are levers to pull in the oil markets where, I don't know, my sense is that these will moderate and not just continue higher. Seth, do you have a thinking on the oil side?
Yeah, I think I agree. I think it's going to take a little bit of time to kind of sort itself out. And I think prices are going to, I think, normalize. Certainly not grow at the rate that they have been. That's our best guess right now.
So let's go a little deeper into the data. So we talked about core CPI, again, stripping out the more volatile food and energy prices. And this shows the core CPI as well as the core CPI just stripping out autos, airfare, and hotels. So interesting that if you take those out, the lighter blue line isn't up nearly as much as it is with those included. That points to these sectors, these reopening sectors, being a really big influence on inflation. So the car market we know has been very tight, due in part to what happened in the rental industry. I don't know if anybody's traveled and tried to rent a car, but it's insane, right? I mean, prices are through the roof. Inventories are very low. It's hard to get cars, partly because they dumped all their cars in 2020 because there was no demand. And then, oh, guess what? Economy reopened. We don't have any cars. So now they're trying to buy cars from the manufacturers while we're trying to buy cars from the manufacturers. The market's tight. Plus, there's a chip shortage. You can't get cars. So really interesting effect. Again, I think it's temporary. I think it's from the pandemic. Same thing in travel, airlines reopening. We saw the chart. People are traveling again. Not a surprise. Airline prices up, and then the hospitality market as well. So I think interesting that when you strip those out, this leads me to think again more transitory in nature than permanent.
Yeah, I mean, we're hearing people paying higher than MSRP for brand new cars.
And waiting, right?
Yeah. What about homes? So we've seen that in home prices as well, just a steep increase in home prices. And again, I think that it's multifactorial, and some of it is because of money supply, and some of it is because of demand, that you have millennials who are looking to build families and who are looking for homes, and there's a lack of supply. So some of it I think is real. I do think it will sort itself out over time. But you're certainly seeing a dramatic increase in the price of homes. Great time to be a seller, not so great time to be a buyer, frankly. Do I think it's going to be like it was in 2009 or 2007? Probably not. But I would expect it to moderate, certainly.
Yeah, I agree. I don't think we see the crash kind of thing like we saw in 2007, 2008, but moderation, yeah. And we are starting to see some moderation in the market. Housing permits off a little bit in June from where they were, loan applications off a little bit. So not accelerating, at least like it has been. And you know, we think over time, rates probably move a little higher and mortgage rates go up a bit and slows the market. So hopefully it'll slow and not just topple over. Looking to another area of prices that doesn't always get looked at as closely, but certainly here in Minnesota, important for our economy, corn, soybean, and wheat prices. So up dramatically over the past several years here, but 82% for corn, 59% for soybeans, and 43% for wheat. So very significant increases in input costs. Now, granted, it was off a low base. Commodities had a weak period for sure, going into the 2017-18 timeframe, but big increases. And we have heard, as earnings have come in from food companies, that they are expecting some price increases. So we probably will see some increases in food prices soon. But at the same time, we know manufacturers do try to absorb some of those costs, especially when they feel they're transitory in nature. So while there may be some price increases, they don't expect to be dramatic.
So Jay Powell, president of the Federal Reserve, has said that he believes that inflation is transitory and that it will resolve itself back to Fed goals of 2% or so. And I'm sure he's looking at this chart and saying, we'll put this in the I'm right column, and that is lumber. And you can see from the slide here, just this dramatic increase in price of lumber. I remember we were talking in the beginning of 2021, when we gave our economic update, and we had We had clients who were saying, well, what do you think is going on with lumber, et cetera? And the increase was dramatic. There was also a lack of supply as demand increased for all kinds of different projects. And now here we are, and you can see basically a greater than 50% decline in the price of lumber over the last 2 months. And so certainly this would seem to indicate that maybe the Federal Reserve is correct that some of these price increases are really not going to be long lasting.
So if we go out and survey people and say, well, what do you think? What's sort of your best guess of inflation expectations for the next 10 years? So right, not next year, not the year after, but sort of over a longer term time range. And inflation expectations remain modest. Consumers expecting 2.8%, that's the highest group actually. Professional forecasters, which are notoriously wrong, at 2.3%. And then the 5-year to 5-year forward swap inflation expectations at 2.2. So the market itself kind of implying even a lower long-term inflation rate.
Yeah, so I think that's pretty interesting. The market is really suggesting much more normal inflation in line with what the Federal Reserve has been their goals.
And that dovetails a little bit into the bond market numbers here. And this is a 10-year Treasury rate. And you can see the 10-year Treasury rate, 1.75% or more, 1.8 back here in January, crashed during the pandemic, had a record low of 0.55%, 0.55% for 10-year Treasuries. I mean, hard to imagine, record low. And then jumped to 1.74 to 1.75% here in March of this year. Really dramatic decrease and increase. And clearly in the spring, I think the expectation at least was that this was going to continue, that inflation was going to continue to run hot, and there was concerns that this would keep going. And the bond market rolled over. I mean, the rates did, right? Rolled down to 1.3%. And the bond market's, forecasting, if you will, what they think is going to happen going forward by having these rates come down, and it's saying, look, we're not afraid. We're not really afraid inflation is going to run away, and we don't really think that the economic growth is going to be maybe as strong going forward as some expect. I think the rate roll down may be a little overdone. It went down to 1.2 actually, and is now up a little bit from there. But clearly, bond market's kind of saying, growth and inflation are less of a concern than they were earlier in the year.
And certainly this is something that we're looking at because, as we showed earlier in the earlier slides, the stock market is telling a different story than the bond market. So our base expectations right now is that interest rates do increase. And we do look at if there was a dramatic recovery as well as a recession. And while if there was a recession, we think interest rates would decrease initially, we still see kind of longer term interest rates going up. Not super significant. I mean, I guess significant to where they are today, but we're not talking about like 5% yields, 6% yields. That we don't see anywhere in the near future. We're hoping that 10-year Treasury rates get somewhere to the 3s. And again, we're looking out like 5 years from now, not like anytime soon. Federal Reserve has said they're not raising rates for the next 2 years. So we're kind of taking them at their word.
So what do higher rates mean for stocks and bonds? Well, the answer is clear and not so clear. So drivers of bond returns are interest rates and credit quality. So interest rates are a direct input. The price is equal basically to the face value divided by 1 plus the interest rate over time. So that's that discounted value over time. So interest rates are a direct input. The higher the interest rates are, the lower the bond price is. So pretty clear that relationship holds over time. For stock returns, the drivers are earnings and the valuation multiple, that multiple applied to earnings. Earnings are somewhat subject to interest rates, meaning higher rates may mean higher borrowing costs for company, thereby impacting earnings, but it's not a direct mechanism per se. And the valuation multiple, If you think about discounting future cash flows in the same way that bonds work, that valuation multiple is often thought to be higher, if you will, for a lower rate environment. And so, again, an indirect but nonetheless directional impact on stock prices as well.
Yeah, so as interest rates drop, that tends to be good for stock prices based on their valuation. That tends to be good for bond prices initially, again, because of that inverse relationship that the bonds you're holding today you can get a higher interest rate than what is being, new bonds are being offered. Correspondingly, when interest rates go up, the bonds, your bond prices tend to go down because you can get a higher yielding bond elsewhere.
So when we look at the longer term side of stock performance, it is definitely related to earnings. And so here the red line is S&P 500 operating earnings. The blue line is the price index, and you can see they're closely follow each other over time. The S&P has had a tremendous run over the last year, close to 4,300. That's 23 times next year or this year's expected earnings of $187. For the quarter, we're at 167 on a rolling basis. By year end, it would be 187. And then for next year, expecting over $200 in earnings per share, implying 20 times earnings, meaning as earnings grow more quickly, potentially, than stock prices do, the valuation of the market goes lower. I think it's important to look at overall earnings growth rates because, again, really that's a significant driver of returns. And for 2021, clearly off, very low numbers in 2020, 28% increase. I think importantly, next year that 14% number, my guess is gets revised upward. That 211 goes higher, and that even moderates this valuation function even more. So clearly, stocks being supported by expectations of high earnings growth going forward.
So today, it looks to me, Mark, that stock prices look a little bit expensive. But what you're saying is that the expected earnings should probably catch up with stock prices.
That's right. That's exactly right. I think stocks are relatively expensive, and we've been in these ranges before for long periods of time. And earnings growth is real, and we're seeing it right now. We're seeing second quarter earnings come in for companies, mostly beating expectations fairly significantly. And this $187 number for this year, this is going to move up. I can tell you right now, we're seeing numbers really, really beat expectations. And we could even see 2021 with a $200 kind of number here. So really strong.
That's not the only metric that we tend to look at within our investment committee to measure the valuation of the stock market. Here's another example that we look at, and this is price over revenue. And this is broken up by the different types of stocks within the S&P 500, the top 10%, bottom 10% in the middle. And what you can see is that those stocks in the highest 10% are at record highs for price relative to the revenue that they earn. We use revenue because it's a little bit more stable of a number, harder to manipulate than operating earnings. But another metric that seems to suggest that prices are on the higher side relative to history.
So even though prices on the higher side, we look at an interesting chart, I think, of 10-year rolling returns. So every point on this chart shows the prior 10-year rolling returns. So really interesting to see how this is varied over time, where very long periods of strong returns back here in the 50s and 60s, again, 10-year returns. So you have over a decade of 10-year returns that exceed 10%. The green line here is the average, 10.4. Again, back in the 80s, 90s, we had another long period where 10-year rolling returns were more than 10%, a long period of time. We had this huge decline after the 2000 tech bubble and then the 2008 recession. coming out, and we've just now gotten back to this really strong 10-year rolling return. And I think it's, not that this is a forecast by any means, but I think just interesting to see the history that we've come out of this really tough period of time. And that if you look at history, it doesn't mean that it's just going to go away. We can definitely have a period of strong 10-year rolling returns. Not that it's going to be every year, but nonetheless, this can continue. It is possible.
So two things that kind of stick out to me, Mark, is I remember back in 2010, there was the conversation of the lost decade.
Right.
We had 10 years of no returns, and you can see that here. The other thing that sticks out to me is that this period reminds me of basically like the late 40s, early 50s. In other words, we had a period of time where the government spent a ton of money to try and get the economy moving.
Right.
Back in the 40s, obviously, it was the war effort. And then it paid off over a good long period of time. So just because, as you said, just because we have greater than 10% growth over the last 10-year rolling doesn't mean that won't continue.
Exactly.
All right, so we've gone through a lot of information, a lot of charts, a lot of data, but Seth, I guess let's cut straight to the chase. What's the bottom line? What is the official outlook that we can glean from a lot of this information presented tonight?
Yeah, I think the bottom line is that we see this rally. We see this rally caused in large part by recovery as well as government stimulus. And we have to give really the growth rate and the stock market the benefit of the doubt. And so we are constructive on the market. We're expecting market returns to do well, not as well as they've done in the past, being that 15% growth. We don't think that is sustainable, but still we expect stocks to do better than bonds and bonds to do better than cash. We do think bonds are going to continue to struggle a little bit as interest rates move higher. Again, as we said, that inverse relationship between interest rates and price. As the interest rates go up, price goes down. But again, I don't think you're going to see dramatic changes in bond returns. You saw 1.3%. Maybe it goes up to between 2 to 3% for 10-year treasuries, and then another couple percent for credit that you get. So you're looking at somewhere between about 2 to 4% bond returns.
Got it. And I think that's a perfect segue then into, Marc, we heard a lot. You just talked about the S&P 500 and company earnings, and Seth's alluding to kind of what the bond market is signaling. What do we think about valuations, not only today, but what they might be, more forward looking?
Yeah, Brendan, I think, we showed the data. Stock valuations are stretched compared to, history, if you will. But I think the fiscal and monetary policy responses are so dramatic that it's sort of distorted the market to some extent at this point. And I think, money flow currently is just having a significant impact on where things are today. So certainly things aren't cheap, but that, is rarely an indicator of future returns, at least in the short term. Longer term, I think the extended valuations will normalize to some extent. We could have a period where things are flattish for a while as fundamentals catch up. We're still positive overall, but if you had to sort of handicap things today versus maybe the next 10 years or so, I think return expectations would be a little more modest than they have been the last 10, which have been really exceptional. We did show that it can continue for a period of time, but I do expect a little more volatility along the way.
Got it. Okay, that definitely makes a lot of sense and kind of ties into the next kind of overarching theme. Talked a lot about inflation. If we continue to have this inflation, is that bad for stocks, or what does that look like, or what can we glean?
Yeah, and we did touch on this early, but some inflation is fine. Some inflation, modest inflation is just fine. It's really inflation surprises that negatively impact markets the most. And again, our research here and our belief is generally that most of the inflation we're seeing is going to be mostly transitory in nature, and that things are going to moderate. So we're not super concerned about inflation, although we do think it heads higher modestly over time.
Got it. Okay, perfect. That definitely makes sense. And Seth, one of the things that I know that I'm concerned with, a lot of our clients are concerned with taxes, and there's been a lot of chatter kind of about different tax changes. Specifically potentially a change to capital gains tax rates. And what can we expect, or what have we seen historically? Have capital gains rates been bad for markets, neutral, good perhaps?
Yeah, so the data is interesting. I mean, we have whatever 2 data points of rising capital gains tax rates, and in both cases, it had absolutely no impact on equity returns. So while it's talked about quite a bit, where the data doesn't really bear that out. Interestingly, corporate tax rates do have an impact on equity returns.
Got it. Perfect. Thank you so much.
So some of the things to consider today, we just want to kind of summarize some of our thinking here, which is first, be careful stretching for yield and risk. Try to remain disciplined with your investment objectives.
Think about your investment time horizon and really discuss that with your advisor. In the short time, markets can be really volatile. Over longer term, it tends to even itself out. So just make sure that the asset allocation is appropriate for your investment time horizon.
Stress test your retirement plans for market volatility and rates of return. We have tools that can help with this. Contact your advisor. We can stress test plans given different kinds of market environments and rates of return to make sure it's robust and is going to meet your goals.
The bottom line is we're in a low interest rate environment, and we expect that to continue for quite some time. And it's essentially a tax on savers. What does that mean? That means that you may need to save more in order to reach your goals due to lower yields.
Be sure to have an emergency reserve, especially for savers, or at least a year of cash for those withdrawing from their portfolio. These are rules of thumb. It's going to vary for every situation and person, but with markets having done extremely well at high relative valuation points now, we do think that there's the potential for volatility, even though we're bullish on the market overall, might not be a smooth ride. And so make sure you have some cash set aside.
And finally, it is my personal opinion that tax rates are going to be going up. Why do I say that? Because they told us that they're going to raise rates. And so because of that, really think about what are ways to save taxes, maybe creating income today in order to reduce future taxes. That could include converting IRAs to Roth IRAs, making Roth 401k contributions, harvesting capital gains. Again, it really is specific to your personal situation, but really think about the biggest drag on portfolios is frankly taxes. And the one thing that's constant is changing tax law.
And it's one of the places we do have some control, right? We can't control the markets, but we can control some of the things that we can do, including having a diversified portfolio, taking advantage of some of the tax strategies.